On paper, Qantas's return on equity soared. Analysts and headlines highlighted this as a sign of renewed strength. But look closer, and you'll see that the equity base was still recovering from pandemic-era write-downs and capital raising. The spike in ROE was driven more by a shrinking denominator and increased leverage than by true organic profit growth. In other words, improved ROE didn't translate to sustainable share price rally. In fact, the increased financial risk became a key talking point for investors. This is a classic example of why you can't take ROE at face value. Teaminvest is an exclusive investment community with over 600 members across Australia and New Zealand. We use our proprietary software and the wisdom of the crowd to analyse companies like business owners, not speculators, to identify wealth winners and avoid capital killers. Our members expect an annual return of a minimum of 15 to 20%, with many of them achieving much more over the 18 years we have been running. At Teaminvest, we're about transferring our knowledge to the next generation of investors. Whether you have been raised with an awareness of investing or whether the family legacy begins with you, our goal is to educate and equip you with the knowledge and tools to build generational wealth. I'm Kerry Fleming, and welcome to the Teaminvest Wealth Builder podcast. I'm glad you're joining me today because we're going to dig into one of the most misunderstood metrics of investing, return on equity or ROE. If you've ever scanned a company's financials and been reassured by a high ROE, I can assure you you're not alone. But as with most things with investing, the story is a little more nuanced than it first appears. Today, I'll walk through why ROE can be both a useful tool and a dangerous trap. We'll have a look at some real-world examples, and I'll give you some practical tips to be able to notice the difference. By the end of today, you'll be able to look at ROE with fresh eyes and avoid those costly pitfalls that can even snare the most experienced investor. So let's start with the basics. Return on equity simply means how much profit a company generates with the money that the shareholders have invested. It's calculated as net profit divided by shareholders' equity. A high ROE suggests the management is using capital efficiently. Investors love ROE because it seems to offer a quick answer. Is the company good at making money with what it has? If you're comparing two businesses, the one with a high ROE often looks like the winner. But here's where the trouble starts. ROE is a ratio, and ratios can be manipulated, misunderstood, or simply misinterpreted. Let's talk about why ROE is so alluring. It's linked to fast earnings growth, the potential for higher share price growth over time, the possibility of faster dividend growth, and of course, the Buffett factor. After all, Warren Buffett often talks about ROE. But these beliefs come with a lot of assumptions. For instance, we assume that a high ROE means that the business performance is strong and not that there's financial engineering. We assume that it predicts future returns, and we assume that if it's good enough for Buffett, then it's good enough for us. But as we'll see, these assumptions can get us into trouble. So let's bring this to life with a real-world example. Let's use Qantas, one of Australia's most iconic companies. After the pandemic, Qantas reported a sharp rebound in profits when travel returned. In 2023 and 2024, the company launched aggressive share buybacks, funded in part by debt, as a way to reward shareholders and boost key ratios. On paper, Qantas's return on equity soared. Analysts and headlines highlighted this as a sign of renewed strength. But look closer, and you'll see that the equity base was still recovering from pandemic-era write-downs and capital raising. The spike in ROE was driven more by a shrinking denominator and increased leverage than by true organic profit growth. Meanwhile, Qantas's share price struggled. The market became concerned about the sustainability of these returns, especially as interest rates rose and the company faced regulatory and reputational challenges. In other words, improved ROE didn't translate to sustainable share price rally. In fact, the increased financial risk became a key talking point for investors. This is a classic example of why you can't take ROE at face value. You need to look at what's really driving the number. Is it real, sustainable profit growth or just financial engineering? So let's break down the main traps. Trap 1, ROE can rise for the wrong reasons. So ROE can go up if profits rise, which is good, or if equity shrinks, which is of course bad. Companies can borrow heavily to buy back shares, reducing equity and boosting ROE, but increasing risk. Trap 2, high ROE doesn't guarantee share price growth. So investors often assume that a rising ROE means the share price will follow. In reality, taking on more debt to boost ROE can backfire if the market views the company as riskier. Trap 3, high ROE doesn't always mean management should retain earnings. There's a myth that companies with high ROE should always reinvest instead of paying dividends. In practice, management needs good opportunities to reinvest at high returns. Otherwise, retained earnings can be wasted on poor acquisitions or excessive bonuses. Trap 4, ROE-based intrinsic value calculations can be dangerous. Some investors use ROE and payout ratios to estimate a company's intrinsic value. The problem? ROE can be artificially inflated by debt, and small changes in assumption can lead to wildly different valuations. Trap 5, the Buffett trap. Many cite Buffett's focus on ROE, but overlook that he also insists on low or no debt. ROE alone isn't enough. Capital structure matters. Okay, so how do you protect yourself? Firstly, we've got to look beyond the headline ROE. Always check what's driving the number. Is it profit growth or is it equity shrinking? Has the company taken on more debt? Watch for rising debt. A company with high ROE and rising debt may be actually increasing their risk, not their value. Be cautious with low dividend payouts. If a company is retaining earnings but not delivering strong returns on those retained funds, ask why. Don't rely on ROE-based valuations alone. Use a range of valuation methods and always apply a margin of safety. And remember Buffett's full approach. High ROE is good, but only when paired with low debt and strong fundamentals. Now let's bring this discussion into the current environment here in late 2025. We're in a market shaped by several years of higher interest rates. After the rapid rate hikes in 2022-2024, the Reserve Bank of Australia has kept the official cash rate above 4% for most of this year. That means that debt is no longer cheap and companies can't rely on low-cost borrowing to fund buybacks or acquisitions the way they did during an ultra-low rate era. Yet we're still seeing some companies, particularly in sectors like consumer discretionary and technology, using buybacks to boost their reported ROE. In some cases, these buybacks are fully funded by cash reserves built up during the pandemic recovery. But in others, companies are taking on new debt to maintain the appearance of capital efficiency, even as organic profit growth slows. Investors, however, have become more discerning of these tactics. There's much greater focus now on the sustainability of returns, not just the headline numbers. We've seen recent examples where companies announced record high ROEs, only for the share price to lag or even fall because the market saw through this financial engineering. One sector where this is especially apparent is retail. Several major retailers have posted impressive ROE figures in 2025. But when analysts dig deeper, they find that much of the improvement comes from aggressive buybacks and tighter working capital, not from genuine growth in sales or margins. We're also seeing renewed scrutiny on capital allocation decisions. With borrowing costs up, boards are under more pressure to justify every dollar spent on buybacks or dividends rather than reinvestment. Investors are asking tough questions. Is the company investing in future growth or just juicing short-term metrics? So here's a few practical tips on navigating ROE in today's market. Firstly, check the cash flow statement as well as the income statement. Is the company generating enough free cash flow to support buybacks, or is it borrowing to do so? Secondly, look at the trend in net debt. If ROE is rising, but so is leverage, be cautious. Watch for one-off gains and asset sales that temporarily boost ROE. These aren't sustainable sources for shareholder value. Listen to earning calls and read management commentary. Are they focused on long-term value creation or just talking up the latest ratios? And lastly, compare ROE to return on invested capital, or ROIC. ROIC gives a fuller picture, especially in a higher rate environment where the cost of capital matters more. So in summary, the market in 2025 is rewarding companies with sustainable profit growth and prudent capital management, not just those that can engineer a high ROE. As an investor, your edge comes from digging deeper and understanding what really is driving those numbers. So as you can see, ROE is a useful metric, but only if you dig into the details. Don't get caught by the traps. Always ask what is driving that number and whether management is creating real value or just financial engineering. To sum up, ROE can be a sign of quality, but only when backed by genuine profit growth and prudent use of capital. Beware of companies using debt to inflate their numbers. Use ROE as a tool among many, not as the sole basis for your investment decisions. So now you should feel equipped to tackle ROE, to understand what it means, how to look deeper, and how to uncover those pitfalls, so you can feel equipped as an investor to make the right decisions. Well, thanks for listening to this episode of the Teaminvest Wealth Builders podcast. If you found this episode helpful, subscribe and stay tuned for more deep dives into the metrics and mindsets that drive long-term wealth. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.